All right, friends. Hopefully, this lecture will end up being worth the wait, whatever that means for accounting for y'all. Anyway, I apologize for the delay and for the state of my voice. It's been a rough week health-wise, as I've described via email to y'all. But I recognize I'm giving this to you a little bit late in the week. I'm going to try to keep it pretty brief. The material, other than the component we'll talk about, depreciation, the other material just kind of follows logically from what we've been discussing before, so it shouldn't take that much time. It's more just, hey, do I have the template of what this financial statement is supposed to look like, and then can I go pull out the accounts from the trial balance and put them in the right spot. So not too bad. Excuse me. All right, so first we're going to talk a little bit about, I actually wanted to put this slide further on. Okay, so we'll, I guess, start with the accounting cycle steps, and then we'll talk about depreciation. So just to remind you where we are, I've brought this accounting cycle up. You may have seen it referenced in the notes that I had you read, the synopses. Different books have different numbers of steps because they, divide some of these steps into more than one or combine, etc. But they all do the same thing, whether it's in 7 steps or 6 or however you want to vocalize the steps. All of these things are accomplished no matter which textbook you're being taught from. So things happen. One of the basic principles of accounting says because of the monetary unit principle, we can basically convert any event in the lifetime of the company into a financial transaction, essentially, and those we can write down in our journal, and that's the beginning of the accounting cycle. So things happen, and then, like I said, we write it down in the journal. That's step 2, or we don't, as you see there in step 2 as well. We talked about that when we talked about adjusting entries. Sometimes we don't record the entry right when it happens, and so because of that, at the end of the year, we'll go in and make sure that we've recorded everything. So we'll either record it when it happens, or we'll go in and record it later. So we record as it happens in step 2. Step 3, we're getting ready to do financial statements. The year or the period that we're in is closing. So we do a trial balance to check our work to this point, make sure that credits equal debits is basically all that's going to do for you. But like I said back in the day, that was at least something to check your work and make sure in transcribing numbers you didn't put something in the wrong column. Again, a little bit less important with the computer. It still needs to be done, though. I guess I shouldn't say less important. Much less tedious. Now you just push a button and it happens. So these actually, happen often daily. Because someone will just say, hey, I'll just check out the accounts, click trial balance, bam, work from that to do something. So in an accountant's life, internally, you may be pulling these, daily, hourly. I mean, who knows? Could be however often because they're, like I said, so easy to pull. Anyway. No matter what, however rarely you do these, you at least need to do them before we start doing these adjustments at the end of the period. Then we do the adjustments, we do another trial balance. These are all steps we've talked about before. And then we do the financial statement. So once we have the adjusted trial balance in hand, that's what we will then take to use to go do our financial statements. Then we'll close out, reset temporary accounts. So again, step 4 and 7 is what we covered in class last time we met in person with the adjusting entries and then closing out all of the revenue, expense, and owner's withdrawal accounts. And I had left, I think when I showed you the steps last time, it was step 5. because I added another one in up here. I think maybe I added one of these trial balances where I hadn't made you do it before. Anyway, financial statements we left out last time, and that's what we'll talk about this time, or that's what we'll practice mainly this time. We'll probably talk a little bit more about depreciation. So 6 is where we're at now, and of course we already talked last week as well about the closing process and then the final check, at which point we're ready to start the next period doing or recording from things happening again. All right, that brings us to our depreciation discussion, which, as I notate there, may not be what you are. This may be another concept that you're bringing with you to accounting that you may not quite understand exactly in accounting terms what it means. So most of the time when people think of depreciation, they immediately think of, well, you're talking about the decrease in value of this item, which if you're talking about book value, that is true. But really the concept of depreciation has almost nothing to do with value, or I should say market value of the asset as time passes. So generally when you buy something, it loses value over time. It's not always the case, but generally that's the case. And the way that we calculate depreciation and the reason that we use it also has the value going down over time. So the combination of those two, and obviously just the nature of the word in the English language of depreciation, makes a lot of people believe that the purpose of it is to track the value of the item, the market value of the item as time passes. That's not the purpose of it. Excuse me. As you see in these latter bullet points, basically the purpose of depreciation is to preserve the matching principle, because oftentimes we'll buy assets that are going to help the company earn revenue over multiple years. Well, if we do that and we only recognize the expense once, right when we purchase the asset, we say, okay, that's equipment expense from day one, $15,000 or however much it was. So that causes year one's net income to be much lower than it otherwise would have been if we didn't have that $15,000 expense. And then there's no expenses associated with that in the following years. So year one has a lot of expenses. Yes, that asset helped to earn revenue in year one, but it didn't use up all of its helpfulness in earning revenue in year one. And so the expenses are not really matched well to the revenues that it helps you earn. Okay, so enter depreciation. Depreciation is basically an accounting lie, but it's a way of saying, hey, we know we bought this in year one or whatever, assuming, let's say, we paid cash. So let's say, hey, we purchased this whole thing outright year one, but to preserve the matching principle, we're going to pretend that we're basically purchasing it over the course of its useful life. So the expense, or the amount that goes on the income statement associated with this purchase, will be split up over the useful life of the period instead of the whole amount being captured in an expense in year one. So that's the basic concept of depreciation. How can we divide up this large expense that will help us earn revenue over multiple time periods into generally, obviously, we want it as accurate as possible. So how do we divide up the cost of this asset that in a way that most accurately matches the cost of the asset with the revenue it helps to earn? Well, most often there's several ways of dividing up that cost. I have the most common ones listed here. We're only going to talk about straight line depreciation, which is basically amortization, which, if you're not familiar with the term, just means dividing up a large number, or any number, I guess, into equal payments over a time period. So straight line is basically saying, hey, let's figure out how long we're going to use this asset, how much it costs, if we'll get any money back out of it when we're done with it, and So down here you see the actual calculation. These are the things we need to know to calculate depreciation. How long, if we don't know, we'll estimate. How long will the asset be useful to us? Total cost of the asset, not just the dollar value of the asset, or I'm sorry, not just the dollars you used to purchase the asset, but all of the money that was required to get it ready for its use, whatever that is. If it's a piece of factory equipment, that could be installation, delivery, etc. And then whether or not there will be any value to you. It could be just scrap metal, or you could be selling it as a used piece of equipment that has more value, whatever the case may be. Whenever you're done with it, it's no longer useful to you, what will you do with it, and will you get any money out of that? Once you have that information, you just say, okay, what total cost to get it ready for use minus number 3 here, which was salvage value, minus any salvage value, and then take that and divide it by the total amount of time that this asset will be useful to us. That gives you the amount each year that will be recognized as an expense. Okay, so let's take a look at an example of this. Toby Company purchases a $15,000 piece of equipment, immediately puts it to use in day 1 of year 1. It's estimated to be used for 5 years with the salvage value of $3,000. How do we calculate yearly depreciation and do the journal entry for year 1 depreciation? Now, well, I'll just leave it at that. Okay, so based on this equation down here, total cost minus salvage value equals 12,000 divided by useful life, 5 years, equals $2,400 yearly depreciation expense. Okay, so that means, in this case, if we assume that we purchased on January 1, then it would be, excuse me, the yearly expense as of December 31st would be the full year's amount. Now, if you purchased somewhere during the middle of the year, this equation that I just gave you would be the yearly amount, but for the first year that you had that asset, if it was purchased sometime during the middle of the year, you would have to prorate the amount based on what portion of the year you had held the asset for. So if you only had it for half the year, you would only recognize half a year's worth of depreciation expense. And then obviously 4 full years, and then the last year that you used the asset would be another half-year depreciation expense. Anyway, the template for depreciation for any asset will always look like this. Depreciation expense is debited, accumulated depreciation is credited. Now, I left out something here that you will usually see, and that is you'll see depreciation expense and a little dash, and it will describe what type of asset. So it will say depreciation expense dash equipment, and down here it will say accumulated depreciation dash equipment. So if you are tracking depreciation, usually, obviously, depending on the size of the company, it may not and almost never make sense to track depreciation on an individual asset basis, where you're saying, well, let me show you what it looks like on the balance sheet, and you'll see what I mean. What I'm basically getting at is usually when you put this on a financial statement, you're not going to list out each individual asset and each individual asset's accumulated depreciation. You'll have them grouped together. Whatever that group name is, that would be what you had here. So if it was equipment or property, plant, and equipment, or however you grouped it. In this case, if we only have one group, we're not separating anything out. everything that we depreciate will all be captured within this accumulated depreciation account and this depreciation expense account. Then we don't need to distinguish and say, hey, this is the depreciation expense account for our equipment, and that depreciation expense account over there, that's for our buildings, or whatever the case may be. So just know that this is the basic template. You will always see this, but you may also see a little dash and a little bit more description as to what's being depreciated. And obviously the amounts will vary based on however much expense you're trying to recognize. If it's a full year's worth, then whatever you calculated for the full yearly depreciation would go in there. If you're doing a partial year, then obviously that would go in there. Okay, so this is just a simplified view, and you'll see when we do the financial statements in a minute what that looks like as well. Assuming that, well, this is basically just assuming that this is our only asset that we're depreciating. So this would be a small component of your balance sheet. Excuse me. So you would have your equipment at the amount you paid for it, total cost to get it to its useful use. And then as you accumulate depreciation, so this is basically showing after 1 year's worth of depreciation here. But as years pass, this number will rise, and so your total net equipment value would be your total cost minus any depreciation that you have already recognized. So obviously this will continue to go down. When you may have heard someone say, oh, that asset's been completely depreciated out, or depreciated out that car, or that whatever. That just means, it doesn't mean there's no value left. It just means, hey, we have now recognized the full amount of that expense. So once this gets to zero, in our case, we said we're not going to go that far. We're going to sell it or whatever after 5 years. Excuse me. Well, I guess that would get us to zero, right? All right, that's right. So that would just get us down to, after 5 years, the salvage value being $3,000. If this had been $3,000 per year of depreciation, then once the 5-year useful life was over, this asset would be completely depreciated out. It doesn't necessarily mean that we couldn't use it anymore. We may have underestimated its useful life. A lot of things can change. That's beyond the scope of this class. Right now, I just wanted to give you enough knowledge to be dangerous as far as depreciation goes. Really what I want you to take away is, hey, if you're asked to recognize depreciation expense, this is the journal entry that you would use. When it's on the balance sheet, and I'll show you when we look at that, this is the format that you'll see where the asset will be listed, or the asset class will be listed, and then there will be a contra asset account, accumulated depreciation, that basically says, hey, this is what we paid, but this is the amount of value that we've taken away from that as an expense, and this is what's left of that asset value. All right, so that kind of concludes my discussion of depreciation. I'll just highlight it briefly when we come to any components of it in these exercises. So like I said, once we've gotten to the adjusted trial balance stage, really all we're doing is saying, do we know what type of accounts go on these financial statements, and can I pick those out of this trial balance? Okay, so for the income statement, I've tried to mention repeatedly, and hopefully I can repeat it some more here. Income statement is just going to be and I don't care too much about the formatting, but it's just going to look somewhat similar to this format with the title. Obviously, that would say income statement, etc. I don't really care about that. Formatting wise, all I really want to see is revenue minus expense. So list out all your revenue accounts, list out all your expense accounts, and then you would have either net income or net loss. If revenue is greater than expense, you'll have net income, which is revenue minus expense. If if expense is greater than revenue, you would have a net loss, in which case that would be expense minus revenue. Okay. In this case, let's see what we got. I'm looking over here, account names until I get down to, and I think I've mentioned this before. Typically, the standard practice for trial balance, and this is usually what your book follows, or what the books that I've harvested information from for this class follow, is listing out typically they will list out your balance sheet accounts first, starting with assets, okay, coming down to liabilities, into owner's capital, so it's kind of set up like a balance sheet already, coming down here to revenue accounts, and then expenses. So typically the income statement stuff is going to be at the bottom, and then well, I guess the income statement stuff and the statement of owner's equity stuff that we will use will all come from these temporary accounts down here. So how do we set that up? Again, like I said, very similar formatting to the heading there. Revenues, expenses, in this case, let's see, that's going to be in net income. So the only revenue account we have, trucking fees earned, okay, 130,000. Then we have all of these expense accounts, depreciation expense. Again, this means that's how much yearly depreciation was recognized this year for these trucks, okay? It's treated, I'm only highlighting that because I just mentioned depreciation, but at this point it's just treated like any normal expense. So we've got that expense, salaries expense, office supplies expense, and repairs expense. And we'll list all those out. Okay, total out the expenses, we get to 104.5. Difference between that is going to be 25.5 for a net income of 25.5. Okay, that will become one of the components of our changes in owner's equity, right? Because the way owner's equity changes, there's 3 ways owner's equity changes throughout the year. Well, I'm counting net income or loss as one item, okay? So either net income or loss will change owner's equity, either positive or negative, based on whether it's income or loss. Then whether the owner puts money out of his or her pocket into the business, that will obviously change the amount of equity they have. And if they take money out of the business to put into their pocket, again, that will change the amount of equity that they have. Those are the only 3 things, okay? So in this case, let's see. Looking over at the capital accounts, I've got beginning capital here, and then I don't see any additional investments by the owner, but I do see some withdrawals. Okay, so in this case, we're gonna have no investments, we'll have net income, and we'll have withdrawals. Those would be the 3 items on our statement of owner's equity. So we'll start with beginning capital. To that, we're going to go ahead and add net income, 25.5. Again, we calculated that already, so we'll just pull that down there. We're going to subtract the amount that the owner withdrew. And that leaves us with an ending balance of 185. Okay, not too hard, especially when you get it in this format where it's pretty well done for you. All right, your turn. You try doing the same thing with different numbers. This is where I would have had you all work together in groups in class. Obviously, you're welcome to do that here as well if you're watching this with one another. I'm not collecting any of this. This is just for your own benefit. I would highly recommend doing it. So, you know, I'll give you a second to pause in between. You know, when I put the next slide up and the trial balance and the question is up there where it just says, hey, do the same thing. At that point, I'll tell you to pause it. Go ahead and do the work. Then I'll say, okay, now unpause and come back and see what the answers are. Again, so that's all you're going to have to do for your practice portion at home this week. The only other work you need to do this week is read the first 2 chapters of the healthcare financial management textbook that I had you all get from Seth. And we will pick up from there. This isn't the only practice. I've got another one in a second here, but just so we're on the same page. All right, very similar here. Excuse me. I'm going to do the very same thing. Only thing that's changed here are the numbers. Okay. So at this point, I would tell you to pause it. Go ahead, over here is going to populate the income statement and then the statement of changes in owner's equity. I'm going to walk through them just like I did before, but you should go ahead and try to do that right now. Pause it, and then come back to me when you're done, and I'll walk through you again. All right, hopefully you're back now. And again, we're going to look over here at the adjusted trial balance. We're going to find all of the temporary accounts. So we go down here, we've got all of our balance sheet accounts coming all the way down to the owner's equity account. And then here we've got our first temporary account, owner's withdrawals. Then we've got a revenue account, trucking fees earned. And it looks like, similarly to the example before, some expense accounts. So as far as the income statement goes, we need revenue minus expense, and then hopefully totaling to net income. If not, totaling to net loss. Okay, so for revenue, we've got $68,000 trucking fees earned. For expenses, $10,000 depreciation expense, $20,000 salaries expense, $5,000 office supplies expense, $8,000 repairs expense for trucks. Together, they total $43,000, which gives us a $25,000 net income. Again, that will become part of our changes in owner's equity. And similar to our other example, I don't see any additional owner investments, but I do see a withdrawal. So our changes in owner's equity, it's going to go beginning balance here. To that, we're going to add net income. We'll subtract owner's withdrawals, and that'll bring us to our ending balance. Go. Okay. All right, now we're going to do the same thing. I'll walk through an example, this time with a balance sheet. So, again, we're starting with adjusted trial balance. And again, down here, starting with owner's withdrawals, going down, those are all temporary accounts. So that means everything above that is going to be a permanent account, so that will be part of our balance sheet. Okay, so starting with trial balance, come over here to the balance sheet. We're going to have assets on one side, liabilities and owner's equity on the other side. Again, not too hard to determine which of these are assets. They're all listed here under the assets. The only thing that might throw you off, had we not talked about depreciation today, is, hey, we've got this credit here within the assets, but like I told you, that just nets together with the trucks to give you what the actual net balance of trucks is, which in this case would be, what is that, 136? Yeah, that would be 136,000. But anyway, all of this coming down all the way to land will all go on the asset side, and then basically from accounts payable down to notes payable, that will be on the liabilities, and then the other for assets. as far as distinguishing between the categorizations of assets and liabilities, again, we said typically this is going to be 1 year. So if the assets will be able to be turned into cash or are likely to turn into cash within 1 year, they're labeled current assets. And our other assets in this case are our long-term assets. These are our plant assets. Then on the other side, we've got current liabilities and long-term liabilities. And again, that 1 year period, when is it going to be due? Is the liability due within the next year? If it is, it's a current liability. If not, it's a long-term liability. So we're just going straight down the line here. Cash, accounts receivable, office supplies, those are all going to go on my current assets side. As far as plant assets go, in this case, I'm a trucking company, so trucks obviously going to be my major plant asset, and then I guess land to park it on, I guess. So we'll total out our plant assets, which are our long-term assets, together with our current assets. That will give us our total asset balance. Over here, we're given, well, interest payable is always going to be short-term. Accounts payable always, these two are default considered unless you're told otherwise. Those are considered to be short-term or current liabilities. In this case, that's all we've got. As far as long-term liabilities go, we're told right there, hey, that's a long-term note payable. Total all those together, and we should, with our owner's capital account, which is our only equity account here, should total out, whoops, to balance, obviously. Otherwise, it's not a balance sheet. Okay, so again, not terribly difficult here. There are some wrinkles that can, there are some wrinkles that can come up, obviously well beyond the scope of this class, but you know, that's the basic gist of it. So for y'all, as long as you have the template of what a balance sheet looks like, just kind of familiarize yourself with the ability of going from this format to laying it out into the appropriate template. All right, your turn. Same deal as before. I'll ask you to pause, go in, give it a shot, see if you can get the right answers, and then I'll work through the answers again. So very similar again, but different numbers. And just like before, these are going to be our asset accounts all the way down to land, inclusive of the credit balanced accumulated depreciation account. Those will be divided between current assets and did I even tell you guys to pause yet? Okay. If I haven't yet, pause. Go ahead and start doing this. Sorry, it's very early in the morning, trying to get this knocked out. Life of an insane person with 7 kids who's been sick all week. Okay, so pause. Go ahead and try this out. I'm assuming you're back now from that, and I'm walking you through the answer. Okay, so this will be divided between current assets and our plant assets again. Similarly, we've got these 3 accounts are going to go into current assets. Cash, accounts receivable, office supplies. Plant assets is going to be our trucks minus depreciation plus land. And again, similar to the format I showed you of kind of, in my example, got the starting price of the trucks minus accumulated depreciation, and that totals out to what's left over. And adding current assets to net trucks plus land is going to give us our total asset balance of 238. And hopefully we'll balance that with liabilities and equity over here. Same deal, current liabilities are going to be these two, since we've got no indication that they are long-term, and that is the assumption. It has been indicated that this note payable is long-term, so we'll make sure and throw that in over here. We'll total out liabilities, and then we only have the one capital account. Let's see. Oh wait, I guess there was a little bit of wrinkle in there because you had to either go back to what we already did to get your new capital balance, or you had to use this information and calculate it again. So again, this was just the beginning balance of capital. What goes in here is the ending balance. So either using the examples that we already, because I think these were the same numbers that I just went over in the income statement examples. If not, you would have to do the same process of calculating net income and then adding that to the beginning balance minus any owner's withdrawals and come up with an ending balance to owner's equity. But again, those should total out together. And if you're just lazy about it, you knew all of this other information, you knew this and this number, so you could have just algebraically said, okay, this is going to be X, my only unknown. I know all this other information, solve for X. That's for you math nerds. I used to teach high school math. I don't know if I mentioned that before. If you're not a math nerd, no worries. Just follow the process that I had laid out before. All right, if you have any questions, let me know. Happy to do any other examples if you want, or go over more in class on Tuesday. All right, thanks.